Google had the long anticipated antitrust judgment against them. It certainly affects Google, but it also affects Apple, since Google pays $20 billion a year to Apple to be the default search solution.
Welcome to the Telltales Podcast, where we discuss cash flow and its pivotal role in investing. I'm Mike Nicoletti.
And I'm Jason Wallace. Along with our co-host Hunt Lawrence, aka Mr. Cashflow, we're here to explore how cash flow drives the economy and investment performance.
And don't forget to join our email list at telltales.us to get the cash flow memo. It's about 20 pages covering 80 companies, U.S. government's finances, and the energy sector.
It's like having a masterclass on investing in your inbox every week.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
I think what we'll do today, we'll get through the oil and gas and the macro pretty quickly, and then resume our march through the 20 pages. I think last time we got through Pfizer, Moderna, so we'll start with CAT in another few minutes. Really not too much to say about Exhibit C. You'll see in just about any news article you pick up on the oil business that the IEA, which is the consumers group, and OPEC disagree about future demand for oil. But the interesting thing is their reports are pretty much on top of each other on demand for 24 and 25. Where they start to diverge is 26, 27, 28. And the IEA numbers, the divergence is almost entirely take up of battery cars. And OPEC doesn't think it's going to happen very quickly, and IEA has a much quicker take up. The price of oil, remember, there's the price and then there's the risk premium. And the risk premium at things like Ukraine, the Middle East. But in the risk premium is buried the willingness of Saudi Arabia and the UAE to continue to curtail production. And in fact, Saudi Aramco, a public company, buy shares in it, reported their earnings. And the head of Saudi Aramco referred to that. And basically what they said, they thought that conditions were improving enough so that Saudi Arabia and Saudi Aramco, which has all of Saudi Arabia's production, would be able to increase production in the fall. So we'll see. WTI is kind of 74 or so. I think the risk premium, a fair estimate of the risk premium is $20. What that means is if you didn't have Ukraine, you didn't have stuff in the Middle East, and you had Saudi Arabia and UAE for various reasons to produce another 2 million barrels a day, that's where the price of oil would get to, something in the mid-50s. Gas demand and supply. Gas is very weak. There's 500 Bs of gas in storage. Just to show how weak it is, the Henry Hub price in Louisiana is just under $2. The Chicago City Gate price is $1.70. It costs, or in tariffs, about 50 cents, or at least, to get the gas from Louisiana to Chicago. But there's a lot of storage, and there's a lot of storage near the market areas. So that's why you have fairly low gas pricing. Government revenues and expenses. Vice President Harris now has a vice president, and probably Donald Trump and Kamala Harris will debate, and J.D. Vance and Tim Weiss will debate. But I'll predict that they'll each go on for about an hour and a half, and no one will be advocating curtailing spending. And what Exhibit A says is that's impossible. So whoever's elected will definitely have to curtail some of the spending. And the two things that we look at every Wednesday, that all other category, which was $900 billion before COVID and is now running $1.4 trillion or so, that just has to, at the very least, stay flat, ideally come down by 100 billion or 150 billion over time. The problem here is, look at the interest expense. In pre-COVID was 380 billion. It's now running in 24, almost 900 billion. there's no way to fix that. I mean, our debt back then was 22 billion and our interest rates were unusually low. Now our debt is 35 billion. I mean, 3% interest rate on 35 billion is about $1 trillion. So you have like a $600 billion increase in spending that we're stuck with. If we turn to, we did the Moderna page, what I think of as the healthcare page last week was the last page we did. Just before we go on to the Caterpillar page, Jason, Mike, any news on Lantheus or Vertex before we go on?
A little bit of news on Lantheus. They reported their earnings, and a little bit has changed with the new management as far as their capital allocation strategy. So they've ramped up their R&D spend. It quadrupled from a year ago, which was a little concerning for us, considering we like the aspect that they were so efficient with their R&D spend. But then we started looking at the numbers, and they've grown their cash flow enough to where that actually still falls within our target range. So we got comfortable with the business again.
Right. Vertex, the pain drug, or any other, the very, very, very early trials on making people insulin independent. Anything there?
Yeah, no updates from last week. But we'll keep an eye out for any news on it, on any of their trials.
Yeah, all I would say is their earnings call was pretty positive on the outlook for the pain drug, and
yes,
promising. They kind of reiterated the promising results in T1D. That's still pretty early stage, but their core business is firing on all cylinders. So CF, they're doing great.
Yeah. And they're positive on their kidney disease treatments as well. So, and that setup looks very similar to the patient population and the unmet need that cystic fibrosis had. So potentially they have another franchise type business that they have a big pipeline in that could be this equivalent size to CF.
Right. That's great. The Caterpillar page, not too much to report. Caterpillar and Deere are terrific businesses. They're U.S. based. They do manufacture overseas. I think both of them manufacture in China, but these are very strong companies. They're fairly large companies. They each have about $10 billion of free cash flow. We've owned family accounts. We've owned Caterpillar forever. It's not to say that Caterpillar's a better company than Deere, but it's a little more affiliated with the energy business. Generac is just a puzzle to me. I came across Generac several years ago, maybe a decade or more ago. It's generators. It's got a dominant position in generators. You'd think with all these weather events we have, it'd be a better business, but they have trouble. If you look at the history here of just hanging on to their $500 million of free cash flow, they seem to quote, when you read their 10Qs, problems with their dealer network, not being able to provide servicemen, and it's kind of like almost the dog ate my homework kind of stuff. But it is an awfully well-positioned company. TransDigm is just one of the really terrific businesses. It makes thousands of parts. They've been authorized for being on airliners. The airline companies have to buy these parts, and it's just a terrific business. Fastenal is a business that I became familiar with a couple of decades ago. There was one downtick in overall market, and I bought shares. You never see a Fastenal store. There are a couple thousand of them, but they're all in out-of-the-way places, not on corners where you're going to be passing them. They're very much a service business. Half of their business is fasteners, saw blades, that kind of thing. They're very service-oriented. The average store has like 3 employees, and they take just terrific care of their customers. It's an example of why you want to invest. If you had invested in the Fastenal IPO 30 years ago and you bought a 1,000 shares for $9,000, you now have received dividends or have market value of around $8 million. So when you hook yourself up with a business that has good cash flow characteristics and grows without having to issue equity, the results are just marvelous. Anything more, Mike or Jason, on the Caterpillar page?
I agree with Generac. Seemed like it was on such a great trajectory. And you're right. If you look back when the share price was much higher, they were hitting that $500 million in free cash flow. And at that point, they'd been on quite a run. And they've sort of got, after a huge fall off, got it back to there. But there's not really the sign that it's going to grow much more than that.
Right.
I'd love to see a different perspective because I think it's a great business, or could be a great business.
Yeah. We've got an awful lot of news in the front of the memo. I was thinking what we do this afternoon, we cover the JP Morgan page. These companies have all reported their results. These are pretty big businesses. I mean, JP Morgan has $57 billion of free cash flow. Morgan Stanley has 12, Goldman Sachs has 18. Again, in family accounts, we've owned Goldman Sachs for quite a while. We're happy stockholders. It doesn't have the same exposure to credit loss. Neither Morgan Stanley or Goldman Sachs. Recall that they were investment banks. And after 08, 09, after Lehman went down, they got access to the Fed window. So what that means is if we have really difficult capital markets conditions, they're able to go to the Fed window with all kinds of paper, in effect, have that used as collateral to get additional capital. So they all trade for in the range of 10 or 11 times free cash flow. I guess you could say that there's not much growth there, but if they trade in the range of 10 or 11 times free cash flow and they have a dividend of, like 3.5%, which means they're distributing about a third of their free cash flow, and they're reinvesting 2/3 of their cash flow in buying in their stock. I mean, these are not bad businesses. I probably should have, B of A and Citibank and whatnot, but I just think in financial institutions, these three are the best. So with that, the next 4 pages are all energy companies, which is, something I'm very familiar with. I'm inclined, I think, to leave the energy companies to next Wednesday. We'll go through those next Wednesday and revert to the front of the memo because there certainly is a lot of news. There was just a huge market dislocation on Monday, which we think, I'll see if I can give an explanation of it, and then Mike and Jason can fill in. I think there was a great deal of borrowing, loans denominated in yen, and the Japanese central bank for the last couple of decades has, in effect, produced zero interest rates in the Japanese government bond market by buying the Japanese government bonds. When we look at Exhibit A and we see that our debt to GNP in the United States is running around 100%. In other words, our GNP is around 35 trillion, our debt's around 35 trillion. We're horrified. In Japan, it's like 150%. But the difference in Japan is that Japanese individuals and institutions are very good at saving money. So most of that debt position of the Japanese government is owned by individuals. Now, the economy in Japan had been in a long-term kind of deflation, and it started to turn around. They're starting to get a little bit of inflation, which they've been trying to do. So the Bank of Japan did increase its rate that they'll try to produce by being a little less active in buying government bonds by 25 basis points. There's so many hedge funds and other investors that had borrowed in yen that all of a sudden everyone decided they wanted to repay those loans or buy enough yen to do it. And everyone was trying to do it at the same time. And you basically had a pretty chaotic situation. Sunday early trading in Japan through the trading day on Monday, don't think it had too much to do. I mean, granted, the valuation of U.S. stocks is very high. It's hard to go through this 20 pages or any other compilation and find companies that are, where you think they're reasonably valued. So valuation came down, and maybe that was healthy, but I don't think it had anything to do with earnings performance of companies in general or macro situation in the U.S. I think it was just that what they call the yen carry trade. A lot of people trying to come out of it at the same time. Mike or Jason, any better explanation of what happened earlier this week?
No, I think you nailed it. I would add, though, that a traditional carry trade, you go from borrowing in yen and then investing in a risk-free asset like U.S. Treasuries. It was pretty clear that people were borrowing in yen and doing practically everything based on what's sold off, right? Everything from cryptocurrencies to the Japanese stock market. And actually, Warren Buffett was one of the people that did that, right? His whole Japanese trade is he borrowed in yen and bought the Japanese trading companies at like 30% of book value. And some of the policy changes have enabled those companies to reach a 1x book value. So it's been a very good trade for him. So he wasn't the only one that was borrowing in yen to invest in something. And once all those unravel, it's you could have a quick dislocation that really doesn't have a fundamental cause.
Anything else, Jason? How did it look to you?
Yeah, I mean, I think you guys nailed it. I would add like the why now is, just a 25 basis point move in Japan caused all this. The yen's strengthening against the dollar at the same time that the U.S. is calling for the Fed to aggressively not aggressively until the market dropped out, but cut rates, today. So that was weakening the dollar. And then the combination of that just put those trades underwater. So if you're going to repay your debt in yen with U.S. dollars instead of I think it was worth 160 yen to the dollar at one point, and then it got to in the 140s. So your gain evaporated.
Yeah. I think you're right, Jason. It wasn't just the Bank of Japan operating. We had, based on recent numbers, very poor jobs numbers Friday morning, and it immediately caused treasuries to trade down. So I think that exacerbated what happened over the weekend into Monday. I'd like to swing now to page 3, which is the chips page on the NVIDIA page. Mike, Jason, and I have some intelligent, inexpensive labor that's going to help us between now and when they have to go off to college. Its granddaughter, Gwendolyn, and a friend of hers, Holly Miller, are going to do a fair amount of work on 2 of the companies on page 3, Taiwan Semiconductor and ASML. What they're going to do is go back to the beginnings of Taiwan Semiconductor and back to the beginnings of ASML and try to get down in a written, coherent way the history of it to help us understand. If you think about it, and they'll probably have 3 or 4 minutes of time next week to explain Taiwan Semiconductor. I don't know how much progress I'll make on ASML by that time, but the written material will be edited by myself and Mike and Jason, and will go up on the Topmark website. Taiwan Semiconductor fascinates me because it is the company that is the kind of the colossus of all technology companies now. I mean, our iPhones, our computers, all the chips are likely made by Taiwan Semiconductor. It didn't even exist until the early 80s. And it was the founder had born in China, moved back to Taiwan after working in the U.S. industry, principally for Texas Instruments, and in effect took a government job. In other words, the government of Taiwan decided they wanted to be more active in this kind of thing and set up an agency to do it, and then hired him. So he, in effect, went from being a government employee of the government of Taiwan to basically widely acknowledged founder and genius behind Taiwan Semiconductor. So, to have all that happen in 40 years is just extraordinary. ASML is a little different. ASML was put together by Intel and other chip companies to make lithology equipment. And again, I think was almost kind of like a trade organization in the beginning. But again, we'll we'll get better. We will learn more about it, and Gwendolyn and Holly will turn out some really first-rate written work, and we'll post it. NVIDIA is come under a bit of headwinds, to pick a marine term, under the theory that their latest chip may be delayed by design issues. But Jason, that delay is months, not anything more than that, right? So in terms of NVIDIA's dominance in data center sales and whatnot, it shouldn't be too significant. Or what's your read on that?
Yeah, I'll start with saying that even if they didn't come out with the latest chip, they're still the number one choice for all the hyperscalers to purchase their chips through. I've seen some conflicting reports that it does sound like there's definitely a delay with the Blackwell chip. Potentially, it only affects a very small portion of the market for the Blackwell chip as it relates to plugging these in as a replacement of the last generation NVIDIA chip. So if you're going to do a one-for-one upgrade to the new chips, they're having some integration issues with the design. So that would be a pretty minor setback for them. The other story is that the whole Blackwell design's pushed out a quarter, so it won't start meaningful production until the beginning of next year. Do you have any other update on that, Mike?
Yeah, what my understanding is the most pertinent challenge that they've had is scaling a Taiwan semiconductor manufacturing process, CoWoS-L, and it's an advanced packaging technology, and they're just struggling with the yields. This is something that will get figured out. It's just they're not hitting the timeline that they had ideally hit. As a result, they're shifting production to scale up some other chips sooner. So the Chinese variant chip wasn't going to use this packaging technology, so that will be released sooner. There's a U.S. lower performance variant that will be released sooner. So they're essentially shifting around their products to accommodate based on the scaling of this packaging technology.
Yeah, the demand for anything that NVIDIA is creating today is certainly there. I don't think they're going to be at a loss for sales.
Yeah, very inelastic demand if you want to get into it. So it is interesting that market react very negatively, but I think as analysts are starting to digest the information, the conclusion is, well, it really doesn't matter.
Right. Jason, you and Mike have predicted that Intel's just very unlikely to catch up with either making the chips, foundry business with TSMC, or designing the chips. And certainly the second quarter results and the reaction to it just looks like what's the expression? To invest in Intel is to try to catch a falling knife. Do you think there's at some level that it would be investable, or is it's just something to stay away from?
Okay, so I'll throw in the good and the bad.
Okay.
The good thing that happened this week is they apparently produced a chip and booted it from the 18A process. So it's the first in-house process. Because currently their latest generation chips are all being made by Taiwan Semiconductor. So that's kind of cool, and we won't see volume production of that till the second half of next year if they hit all of their scaling timelines. And as we pointed out, based on Taiwan Semiconductor struggling with scaling a new technology, you sort of have to expect that Intel is going to struggle as well. I think that I guess there is always a price that's low enough to justify. I don't think we're necessarily there yet. There's a lot of debt in Intel, and there is a lot of more of their more recent deals are done off balance sheet. From a American manufacturing perspective, we'd love to see them do better. So I'd say we continue to hope that they do well, but be very wary of the value trap.
I think they need drastic action sooner than later. This quarter was bad. They're projecting losses for at least the rest of the year, and they're going to have a huge amount of layoffs. And this is with them accepting $8.5 billion of government U.S. CHIPS Act money.
Yeah. Hey, they finally cut the dividend.
They did cut the dividend, yeah. But they're also cutting their CapEx plan, which is what the CHIPS Act money was for. So that's disappointing. I think they're in a really bad position. I saw one analysis of as soon as a chip manufacturer's revenue falls below 2 times the cost that it is to build a new fab, then they're in danger of never catching up. So the cost to build a new cutting edge fab is $30 billion. And Intel's currently running $55 billion in revenue. So they're below that threshold. No company, and I think we've said it before, once a company falls behind, they've never been able to catch up in the history of the industry. So there's a real danger that they'll never be at the cutting edge. They'll never have a chip design that's better than AMD's because AMD is using Taiwan Semiconductor. At the same time, x86 chips, which is what Intel produces, are becoming more and more relevant. So if they were to catch up or finally split the business between chip design and chip fab, by the time they do those things that could rescue the business, there might not be a market for x86 chips. The latest, AI laptops that are running Windows are built on ARM chips that Qualcomm's producing. So if Qualcomm gets into the laptop business, the CPU business, that could potentially shift the market and take away Intel's PC business. And they're already losing the data center business. So they're not in a good position.
We have some news on page 1. We've got about 2 minutes left. We'll cover this news next week, but Google had the long anticipated antitrust judgment against them. It certainly affects Google, but it also affects Apple, since Google pays $20 billion a year to Apple to be the default search solution. All these companies now have reported earnings. As Jason said earlier, it doesn't look like there's any diminution in demand for NVIDIA's GPUs and other data center products because, as the Google CEO said, the risk of underinvesting is greater than the risk of overinvesting. So there's a fair amount of complaints from portfolio managers and analysts saying, gee, that spending is pretty high. I saw one commentary where they said Microsoft's CapEx in the second quarter was more than they usually spend in a year, if you go back a couple of years prior. But Mike, Jason, anything else that's that's newsworthy that we can sit on and get into next Wednesday?
The decision on the antitrust case against Google is super interesting to this page. It affects Apple, Microsoft potentially. That they were found in violation of antitrust law by signing the deal to become the default search engine on iPhone. So I guess the decision boiled down to is they have a monopoly in search by being the best product, and that's fine. It's a legal monopoly. But then using that position to pay off potential competition, to stifle competition from Apple was the illegal part. That's my non-lawyer understanding.
Right. And if you think through the things that'll happen next, it's Google will continue to make those payments as they go through this appeals process. My understanding is the current deal between Apple and Google runs until second half of 2026. It's very likely it'll be in appeals, if not all the way through that, pretty darn close. So the reality is it's probably going to be status quo for a while.
Yeah, maybe. But does it matter past next year is something I want to talk about.
Yeah.
next week.
We're going to have to save it for next week.
We'll get into it next week. It's a good thing we hold these things for 30 minutes. Otherwise, we go on way too long.
Mm-hmm.
Anyway, everyone stay well and be healthy, and we'll be on exactly a week from now. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.